Alright, welcome to the next edition of our video. So in this one, before we proceed, I just want to, because I know I was all this while I was explaining using all of these models, but I want us to go and see real life chart examples and drive home the message so you can get exactly the picture of what I'm saying. So I know just know that it's not things I was just drawing and generating over. Okay. Yeah, so it's not just about these things. Okay. So now let's see if you can actually spot what I taught you, what I said is going to happen whenever you see any of the M's and W's on your chart. So we want to go right into our chart now and scavenge just to grab few examples so that when you be practice, I want you to practice before we begin to go to the next level now. I want you to practice spotting these things I explained. Remember, I gave one concrete example of, let me drop down to a lower time frame rather. Remember I said when you see an M or a W, when you see an M or a W, the market is either going to come down to the mitigation block. Let's say an M to come to the mitigation block and drop. It's also need the mitigation, it's going to use the fair value gap or another block and then it's going to drop. Okay. Then the same thing here. When you see a W, the market come down and use the breaker block, the fair value gap or the other block to what? To buy. That's the thing. This is summary of what I taught in the last video. So now let's go and see if this is actually true. Now, going back to the chart here, we do this a little, yeah, this is a little example of what I actually taught. If you look at this, there's a little boys. The M is not very clear. This is like an M kind of taking out a high, dropping down your stand. So, but let us just be like this is like the last leg of the M. But this one is not, the pattern is not very clear on this one. So I won't use this one to explain. But me, I can see this as an M actually, which the market used another block to drop down. Well, let me see if I can get clearer. So for a beginner, someone who is not too used to the charts, because the more you spend more time with the charts, you begin to spot certain things you never knew was there. Okay, this is also a W. Good. See, I just saw this one now. This is the first leg went up, created a small second leg, boom, and then it went up again. Okay. Now, I said that inside of this leg, this last leg, you are looking for two things, either a fair value gap, an order block, or either a breaker block, a multiplication block. So you can see here now the market use all of, even in this sometimes you see all of them. I can see it. Can you see this? What is this? Let me let me draw it again. You see this fair value gap? Man, this thing is very faint. Let me use red. Okay. So maybe my network is, I think my network is not showing. Network is bad. Oh, that's network. Sorry. I think I have to pause the video till the network is restored. Then I'm going to continue. I think the network is back. So if you look clearly, you see that there's a fair value gap right here, right? The market made use of the word, the fair value gap. Now, apart from the fair value gap, you can see market just like I explained exactly. When you see a W, the market goes up, drops the fair value gap, and then it goes up. So this is where you're supposed to buy. And when you buy, as the market just went up like this, you should be in profits. You can see it's a very simple strategy. Now, if let's say you do not see fair value gap, or you don't know what is a fair value gap, or you don't want to use fair value gap, like I said, any one of your choice, anyone, just make anyone your favorite. Now, can you see that the market use the word and order block? What did I tell you? The last down close candle, which is this one. So even if you had used the other block, the market still respected the other block. Let's say you did not use the other block, you still use the consecutive other block. Here you see one, two, three, went down before going up. Can you see? Three of them. Market still respected it. So you can see that. So whichever one you want. Okay. So that's it. Let's see if we can see another example, one more example, then we'll go. Remember money, okay, I just broke down to a lower time frame though. Supposed to do this thing with the higher time frame. But still, I told you that anything you can see on a lower time frame can also be found what on a higher time frame. See this beautiful M. Went up, came down, went up again, then broke. You cannot consider this one, remember, because I told you that it didn't take out this low, right? But this one broke this low down. Do you see that? And then, okay, this is only perfect example. This one now, this is a what? A mitigation block. I finally found the example I'm looking for. So we've seen an example for mitigation block. Network has started misbehaving. Network is beginning to go up. Okay, good. So do you see that market came back to the mitigation block and then started dropping? So if you are sold there after spotting this M pattern as the market is dropping, you are making what? Profits. You see that? Now let's go to the higher time frame that I wanted to. 30, or let's just use 1 hour. Let's use 1 hour. Let's go back to our starting points. Let's go to the left, right. Okay, look at this point here. Now let's go back and see something. Doppler M and W. Okay, I can see something small. Let me zoom in. Can you see this leg? This is W. First leg went up, came down. Second leg took out this high. Let me make it. Can you see that? First leg went up, came down, went up again. So what do you see? The market came down towards an order block. This is an order block. In case you're not seeing it, let me highlight it. You see it? So imagine buying on this order block. This is a fair value gap, a very small fair value gap. You can see buy whichever one. So you buy here, the market goes up. You see it, you're making profits. So that's that for that block. Let's see. Let's go and scavenge for another example of where things like this are occurring. Look at it again. CW, see it. Market went up, came down towards consecutive order block. Can you see that? Oh, it's like I even traded it at some point. Can you see the order block here? Market went up, came down to this one. If you did not see this fair value gap, look at consecutive order block. Can you see that? The market respected it, tapped on it, and took off. Should be making profit here. Using this strategy I'm just teaching you now. Free strategy, easily, like easy peasy. So let's see one more example. Okay, perfect examples. We can see W. Okay, came down towards. Can you see that? This is one leg went up. I think I've actually traded all these things. Then that's why I'm even seeing some highlights on it. So these are things I've already been marking on my chart since. So that's it. You can see market went up after creating this W. It took out this high. Remember, I said the second leg must take out what? A high. The last high. It took it out. Now there are a series of what? See fair value gap. So the market didn't use this fair value gap. It used the what? The other block. So even if you didn't use this other block, you want to use this one safe, no wala. Market still respected it, dropped it, and then rallied up. So if you are buying here, anywhere here, whether you use this one to buy you fair value gap, or use this other block to buy, or use the consecutive other block to buy, you would have still been what? Profit using this strategy. And look at the one that is up. You only a small M, I think. Yeah. Market goes up, comes down, goes up, create the second leg. It broke this low. Look at this leg, broke this low, created a little swing, went back up towards. This is a breaker block. The last bearish candlestick that went up and took. Okay, if it didn't take out this high, let me check. Okay, took it out now. I'll be almost. So if it took it out, then that is a breaker block. But if it is not, it is a mitigation block. So whichever one. Okay. If it didn't take it out, then that means it's a mitigation block. Then as market just came back to it, you should be selling there, right there. Okay, right there. So if you are sold here, look at how the market dropped. This is very simple market drop that you make your money cool. And then as it's dropping, you give you a buy. Imagine selling here, buying here. That's money. So you can see how interesting and easy the strategy is. So there are more things you need to do. Remember, I've not talked about what you have to do on the lower time frame. But first, at least I'll give you an overview of what you should be expecting. Even if you didn't even watch the next video, but now you should know what you should be expecting. Looking for your M and W's on higher time frames. Then the next thing you want to do, you want to check the conditions that makes an M a perfect M. Why should I use this M? Why should I not use this one? What makes this W a perfect W? You understand? When I see a type 1 um, W and M, I should know that I should be expecting either a mitigation block, a fair value gap, or an order block. If I see a type 2 M or a type 2 W, that means I should be expecting a what? Sorry, a type 2, yes, type 2 is mitigation. But if mitigation block, you should be expecting that yeah, a mitigation block, a fair value gap, or another block. But if you see a type 1 or type 2 M or W, you should be expecting what? A breaker block, fair value gap, or another block. And that is what I've covered so far. And those are the key important institutional reference point that the market will reach for, and then it's going to reverse. They are not magic. These things have been there existing. So go back to your own. Choose your own favorite pair. It must not be my own. I use GBP USD as a case study. These things work everywhere, every asset market. Can be it's in gold, it's in Euro USD, it's in Nasdaq, US30, oil. Check them. You see this thing I'm telling you. So pick your own favorite pair, go and backtest these things and share your results with me. Thank you for watching.